I'm interested in Google sub 100, that return is very important. This is part of the shift I think that's happened in the tech industry. The market changed like that. It's so big. All right, guys, Google. I love talking about these companies. We're talking about a lot of great companies lately that have seen a fall from grace. I remember doing a video a year or two ago when Google was 150, and I was saying, hey, I'm interested in Google sub 100. And somebody said in the comments, Google will never be below 100. And I was like, that's a stupid statement to make. It could never see below 100, but guys, markets go through cycles. And what that told me was that person's never been through a down cycle. So guys, if you're new to the channel, I'm here to teach a process. If you just want to find out if you should buy Google or not, I don't blame you, but I'm here to teach you how to figure out for yourself using our software, how to find good investments and what to value them at. So if you like that idea, if you like the idea of being a learner and somebody who could be independent, then subscribe to the channel right now. You're going to learn a lot of stuff, but let's go use our software now to go figure out more about Google. So first off, let's pull up Google. All right, here's that long-term chart. All-time high, February 2nd, 2022, 152.10. 52-week low, 83.45. It's currently at $89. All right. Market cap, 1.16 trillion. It was over 2 trillion, I think, before. Enterprise value, 1.24 trillion. That difference is the debt, essentially. So it's about $80 billion in debt. Is that 80 billion? Yes, $80 billion in debt. Not a ton. For a company this large, not a lot of debt. In fact, go look at their cash on hand. They currently have $166 billion of cash. They can pay that off very quickly. Couple other things I like. High gross margin, 56%. That means for every dollar they bring in, they add 56 cents to the bottom line before taxes and overhead. And their bottom line after tax and overhead is a very consistent 23% over the last 5 years, 23.7 in the last year. Now, have you seen in the news lately, Google has been talking about cutting employees and cutting benefits, et cetera, to save costs. This is part of the shift I think that's happened in the tech industry. The tech was high flying. You could do no wrong. Losses were fine. Now everybody cares about profit more and more. So Google's and all these other companies are sitting there saying, listen, we've seen a slowdown. This very channel you're on right now is on YouTube, the second largest search engine in the world, owned by Google, right? They generate a lot of money from this. I think they paid $1 billion for it, maybe $1.6 billion, something like that. And it generates $17-20 billion a year in revenue or something along those lines. The point is, it's the world's largest search engine, basically largest advertising company, and people love how simple it is. Do I think Google will be around for the foreseeable future? Yes. Do I think it's going to make more money in that foreseeable future than it does today? Yes. The third question, the most important one is, can I pay a reasonable price for it today to get an adequate return on my money based on those assumptions? That's what we're here to figure out. So let's go to the 8 pillars that have made this channel so famous. 5-year PE, 25.7. 5-year price of free cash flow, 27. Those are the only 2 X's. Everything else is up. Look at this. 5-year return on invested capital, 14.37. Not as high as Microsoft, not as high as Apple, but that's really solid. Shares outstanding, I don't like this so much, guys. This has probably happened in years where they were massively overpriced. Now they're starting to get to a better level. Is it good to buy back shares when things are overpriced? I don't think so. And I don't like that. To me, that's not a good use of the capital. I'd rather see them return it to investors in a dividend if they really want to give money back to investors. Don't go buy back expensive shares. I don't like that at all. But look at this. Very low debt. They can pay off all their debt with 1 year of their last 5 years of free cash flow. All right. So let's see what the analysts are saying about Google. All right. Earnings per share. They're expecting $5.39 this year, $8.11 in 3 years. Double-digit growth. Pretty solid. But look at the revenue, guys. Not a lot of revenue growth. Why? It's so big. Isn't it banned in China too? It's just so large. You can't expect large companies to grow like crazy. But with a high return on invested capital, it doesn't take much growth for them to add a lot of money to that bottom line. That's the great thing about that return on invested capital. And you should be willing to pay a larger price for companies with a higher return on invested capital. This is something that's shifted a lot for me in the last 2 years. And I really accentuated a lot more on this channel as of late. That return is very important. Now, again, if you're new to this, please don't worry if you get confused. I was confused to start. You know what I did? I just started learning one thing at a time. We have 2,000 videos out there, and the number of people who message me on Instagram, Twitter, or anything like that and say, man, Paul, I really started to understand this. I love it because it's true. It does take time. Don't feel bad that you're not getting it immediately. Rewatch this video. Watch other videos. It will make a lot more sense. Listen, I know successful business people who talk to me about investing and I just go, what are you doing? Because it does take time. But guess what? You don't need to be really smart or super successful to understand investing. My cousin's 30. He's an engineer. He's successful. Don't get me wrong. He's probably watching this now. I'm going to get a text from him saying, you don't think I'm... The bottom line is I talked to him about investing and I'm like, damn, this kid gets it. He understands it. There are people in the community who are in their teens. Literally, we have 18, 19-year-olds in there and they message me. I'm like, God, these guys get it. They look at it and say, every investment is the present value of all future cash flow. The question is, what's that cash flow going to be? Okay, we don't know. Now, before we go to the stock analyzer tool, some of the things I want to bring up about Google. The advertising is an issue currently. But remember, you don't want to fog your brain on short-term issues in a company to make it determine your value for the next 30 years. No company in history has ever just gone straight up. There are always issues with companies. Always. Look at Apple last year. They had issues with manufacturing phones. There's always going to be issues. Look at Southwest Airlines. Southwest is probably the best run airline out there, and they're going to lose $800 million because of their flight issues over the last 1 or 2 weeks of the year in 2022. But guess what? Don't ignore a company because of a short-term problem, and don't buy a company because of a short-term benefit they have, right? Just like Zoom. Everybody was buying Zoom when the shutdown happened because everybody's using Zoom. I was just like, well, the shutdown's not going to last forever. This is not going to last forever. This is stupid, right? Shipping companies have surged in the last 2 years because of the shutdown and the supply chains. I'm not buying them just because they surged for 2 years. It's going to come back down to normal. Look at the car business. Used car prices are plummeting. They were skyrocketing for the longest time. Now they're plummeting. I had a car that I was selling, and right before the bubble burst on used cars, I got an offer for X. I said no because I thought he was a little short, about 10,000 short. I just ended up selling it last month for 20,000 less than that offer. Okay, that's how fast it changed. The market changed like that. But what you have to do is determine a long-term projection of the company. And that's what the stock analyzer tool does. It allows you to sit there and pick 10, 15, anywhere between 1 and 20 years to analyze a business. Okay. Now, I sometimes do 10, I sometimes do 20. It's just, how do I feel? But we're going to look at this company right now in a 10-year analysis, and I'm going to look at revenue growth, profit margin, et cetera. So the first thing, now, by the way, guys, I always say this in every video. This right here was used 1.3 million times by our users last year. It is the most popular part of our software. So if you're interested in it, go to everythingmoney.com. We have a risk-free guarantee. Go use the software. If within 30 days you don't like it, email us, money back, no questions asked. So check it out. It's well worth it. It's less than $1 a day. You're crazy not for doing it. Okay, so revenue growth over the next 10 years. Now, they had a lot of growth in the last 10 years, but I imagine the next 10 won't be as exciting. So I'm going to do 3, 6, and 9%. Seems low, but actually it might be a little too low. Let's go with 5, 9, and 13. Now, I just changed that pretty quickly, but I'm glad I did because I want to show you my thought process. 13 is very high, I think, for the next 10 years because of how mature the company is. But let's say they hit gangbusters. Let's say some of their side bets work and they find another revenue stream in their company that really skyrockets. I don't know. Might happen. But remember, my high assumption isn't supposed to be something where I'm like, oh, it's definitely going to happen. Now, would I be shocked if their revenue growth was only 5% a year? Absolutely. I'd be like, wow, that's it? The world economy and things like that are growing at 5+% a year. They got to grow faster than that, I would think, especially with the kind of business it's in. And somewhere in the middle, 9%, it's still a lot, but I could see that happening. So that's where we're staying. That's the art of investing. It's about making assumptions about the future. What's right, what's wrong, I don't know. If I asked one of the thousands of people in our software to sit there and make their own, they're going to come up with totally different numbers than I will. Sometimes they're more conservative than me. Sometimes they're higher. Mo and I have different numbers all the time. It happens, but that's the point. The more and more you do it, the more and more feel you get about it. All right, now profit margin. It's pretty consistent here. So I'm going to go 21, 22.5, and 24. Let's say they're able to make it a little bit better in the future. Actually, let's go 22, 21, 23, and 25. I'm going to do the exact same thing with free cash flow because it's pretty similar here. Now for PE, the current PE is 17.3. The current price of free cash flow is 18.5. With this high return on invested capital, 14.3% they have, I could understand probably people saying, hey, I kind of like the company here. Right? I mean, that's not too high a price for a really high return business with very little debt, very secure and a dominant. We say Google it. You don't say Yahoo it. You don't say Bing it. You say Google it. Even if you don't use Google, you say Google it. If I told you right now to go learn something on the internet, where are you going to go? Google, and it's going to take you to YouTube. They're dominant. They're absolutely dominant. And is it possible that shifts? Sure, but that's why we have to have our margin of safety when we do these investments, because it is possible next 10 years, somebody overtakes them. That is possible. The question is it probable? All right, so PE. I'm going to go low side 15, 17 and a half, 15, 17, 19. And then for my desired return, guys, remember you can get 9 or 10% by investing in a long-term ETF. And this is my margin of safety. So I'm going to go with 12, 14, and 16 because this is really high. Actually, I should go higher than this one. I'm actually going to go a little bit higher on this one. I'm going to go 18% on this last one. Because I look at this going, man, I just don't see how they do these numbers. I mean, is it possible? Sure, but man, these are really strong numbers. So I really want a much higher return to make these assumptions. All right, the stock's currently at 89 bucks. Hit the analyze button, boom. Low price of 67, high price of 109, mid price of 90. So guys, I beat this thing up and I still got to almost 70 bucks. And I think that low number is pretty low. Now I did something that's like, okay, 9%, all right, kind of makes sense. And if you see right here, I have it in my watch list at 85. This does not mean I'm buying it at 85. And I don't want everybody out there just saying, oh, Paul's buying it, let me go buy it. You need to learn to analyze companies yourself. That's key. My friend Gary is a great investor. I'll look at a company he owns sometimes and go, why the F does he own this? And I'll ignore it. And he looks at companies I own and go, why the F do you ignore that? Why the heck do you own it? I own it. I like it. Everybody has their different process. I'm here to teach that process. So you can add it to your watch list. I keep mine at 85. This is basically Google. I think you need to realize that it's a great company that's fallen in price. When people thought I was crazy, go look at the past videos. It'll never go that low. Well, now we're talking about Google being 4 out of 6 green numbers. That's pretty solid. And it's a big piece of the NASDAQ 100 and S&P 500. So there's a way to sit there to probably buy it at lower prices. So guys, if you like this, subscribe to the channel, watch more videos. I guarantee you'll walk away with a better understanding of money and finance. Thanks very much for your time.